Hi, welcome to this edition on managing your money. I am here today with my co-hosts, Adam Strauss, Matt Bloom, and Josh Strauss. And today the subject we'll be talking about is Bitcoin. Many of you, I'm sure, are unfamiliar to the Bitcoin story, or there's probably lots of different levels of interest and knowledge about it. So we'll try to speak in general terms as much as we can. And maybe I'll start with this question. How do you guys feel about having Bitcoin as part of a diversified portfolio?
Well, I'll jump in. Um, so for years, Bitcoin has been a little concerning as an investment in the fact that, it's basically vaporware. You don't really know, what the hell is there, if anything, to start with. And there was the risk of potentially having the SEC or other powers that be make the usage of Bitcoin illegal because setting the price of money is something that's belongs to the government. Now, in January of this year, when the SEC approved for the first time a spot Bitcoin ETF, which basically giving tacit approval to it as an asset class, which really helped me personally to feel much more comfortable about it as an asset class. I think it is a diversifier. I think it is highly volatile. It's not for the faint of heart. I think that for a number of reasons, I think returns over the next 1, 2, 3, 5 years in Bitcoin should be pretty good. But the volatility is going to be painful. It's going to double many times. It's going to have many times. And you just have to know what you're in for, because it's the kind of investment that I think that you want to buy, close your eyes, and revisit far more irregularly than you are the rest of the portfolio.
Thank you, Josh. Does anybody else want to comment?
Well, I think that to just add, I agree with everything that Josh said. It is a high risk, high reward kind of investment, and therefore it's not appropriate for everybody. There are some people where they probably just shouldn't have done it. Volatility is too high. And then there's others who are, perhaps on the more aggressive side of the investment spectrum, where it's appropriate to take a small position. And when I say small position, I think the kind of position where, well, the way that I think about it is there's a chance that you could earn multiples of your money on your investment, but there's also a chance that it could go to zero. So it's sort of like investing in a startup venture capital backed stock. There's your chance you could do very, very well, but there's a chance that you could, lose everything. And so you wouldn't want to invest any more than you're prepared to lose. And so, I think, for those clients where it's appropriate for, I'm thinking a 1% position is appropriate for some people, 2% at most. But, I think generally 1% is probably about the right level. And again, I think it depends completely on the investor. For a lot of investors, 0% is appropriate.
At what point, Adam, did you start to get interested in Bitcoin?
Well, I got interested in Bitcoin. I think Bitcoin, I don't remember exactly when, but I think what makes, but anybody who knows how I invest knows that I'm very bullish on gold. Gold is a hard asset. There are geological characteristics that prevent how much supply can be added. And it has a nice long history over 5,000 years of being a monetary asset and store of value. Bitcoin is different than gold, but it has a lot of similar characteristics of gold. It's been described by some as digital gold, and I think there's something to that. What makes it similar to gold is that I think that for the most part, people are buying Bitcoin to own it, and they're owning it as a hedge against the depreciation of fiat currencies. And what makes Bitcoin a useful hedge against the depreciation of fiat currencies is the fact that its algorithm prevents the supply of Bitcoin from expanding too much. There's a little bit of additional mining that adds supply today, but it's a very small percentage. And every once in a while, the percentage that's allowed to be added gets cut in half. And there's going to be a point where you can't add any more Bitcoin at all, where the fixed number of Bitcoin is stuck at 21 million coins. And so, you know, in that respect, I guess it's not just similar to gold, but anything that has scarcity value. So it might be, you know, a collectible, like like an important baseball card, or like a beautiful piece of art. But I've never been good at, you know, figuring out what's going to be the popular baseball card or what's going to be the important work of art that triples in value. A Bitcoin is just a Bitcoin. So you can just buy the Bitcoin and assume that it's going to appreciate, because there's never going to be more than 21 million of them overall.
I think that's right. I think with this, the halving just happened around April 20th or so. And so each Bitcoin mine now, or each block, and think instead of 900 Bitcoin is that 425 Bitcoin, there's something like that. And so every 4 years there is a halving, and which means that the amount of Bitcoin mined gets cut in half. And that goes to your deflationary point about supply. Supply is deflationary over time and going to zero. I think on average, the amount of gold mined a year is averaged around 1.5% of the gold, of the average gold base outstanding. With this new Bitcoin halving, the new Bitcoin supply coming on per year will be like 0.7 or 0.8%. It's almost half of the production level of gold. So it really is a deflationary asset. And in light of a very inflationary world in terms of money supply, or the growth of money supply throughout the world, not only in developed countries but in developing countries, it's shocking to have a store of value like gold or Bitcoin that really is deflationary in nature, or moderately inflationary with gold. So yeah, I think there is a lot of store of value in that. I'm going to say something that will surprise you, and I'm going to show you a chart, because Josh is correct that Bitcoin is volatile. There is a lot of volatility in Bitcoin, and it seems to go through cycles, which I'll talk about. And I think for any client, they have to be comfortable with the level of volatility in Bitcoin. What's interesting is that over time, the volatility has moderated, and it's moderated a lot, which makes sense. This is $1 trillion asset now, right? It's hard to call something not real or vaporware that's worth $1 trillion. And also the fact is people tend to forget that as this asset has matured, its volatility has declined over time, which is true, similar to a lot of other maturing assets. And I think what would shock most people is that at least the 360-day, or the looking backward 1 year volatility. Now my data is ending on 12/31. Bitcoin is actually on a 1 year basis, not on a since inception basis, but on a 1 year backward basis, is less volatile than NVIDIA, Tesla, Amazon, and Meta. So I'll show you this in a minute. So when we bring up Bitcoin to most people, they would say, or the reflexive action is, I can't own it, it's too volatile. Yet the average investor is happy to own NVIDIA or Tesla or Amazon, not even thinking of its volatility. And yet those assets today are more volatile than Bitcoin. And I will show you. So this is a chart, when you can see my screen, of the magnificent Bitcoin volatility versus the Magnificent Seven through, it looks like it's through December 14th, 2023, so almost exactly year end. And you see Bitcoin is this black line here. And in the inception year, in the early years, it was incredibly volatile. I mean, just off the charts, volatile. But as the asset has matured and it really picked up steam and became more of a mainstream asset, I would say during the kind of second halving, or this, I guess, would be the third halving cycle, or second halving cycle of 2017 or so, the volatility began to decline, or post that cycle, and it's been declining ever since. And here we are today, less volatile than, as I said, Tesla in red, NVIDIA in pink, Meta in brown, and even Amazon in sky blue. I think that's kind of interesting.
And logically, you would expect that fall in volatility to continue, given that you're now with the approval of all of these new spot Bitcoin ETFs, you're bringing in all kinds of new investors, right? It's not just kind of the decentralized finance people that used to be the only sort of Bitcoin investors. Now you've got a much more retail centric and broader investment base or investor base, which you would think would ultimately cause this volatility to continue declining over time.
Agreed. And I think the approval of the ETFs in January 10th of this year has been a game changer for Bitcoin, and you've obviously seen a surge in price in Bitcoin. It has been the leading returning asset across the board so far this year, and even on a risk reward basis or a Sharpe ratio basis or a risk adjusted return basis, however you want to say it, it's also been the number one asset this year. Now, that could always change, but I want to go back to something that both Adam and Josh said. I think what's hard for clients. So the first myth out there is that Bitcoin is extremely volatile and it's too volatile, and so therefore it's dangerous. And I think we're trying to poke a hole in that. Yes, it was historically, but things are different today. And as Matt suggested, they may be even more different going forward as it becomes more mainstream after the approval of the ETFs. But there is a kind of a nagging question about the underlying value of Bitcoin, which I understand, and certainly I can't forecast what the price will be, and you can't take a typical finance calculation or a DCF calculation, right? Because there are no dividends or earnings in Bitcoin. So I understand people struggle with trying to understand what Bitcoin is worth. I would argue that you could have a similar struggle with gold, although you can measure gold's relative value versus stocks or oil, and it has a much longer history. But the underlying fundamentals, hard to understand what gold is worth as well. But Adam says something that's interesting, and he talked about baseball cards or sports cards and art, and in a way it seems silly to compare, on the surface at least, Bitcoin to art and baseball cards, but I actually think there is an analogy here, and this is not my thought. The credit goes to Ben Hunt, who was a investment manager and kind of investment blogger, and I think a really deep thinker about investing. And he basically made the analogy, I don't know, 4 years ago, that Bitcoin really is art in some way. That just as it's like fine art, that the way the system works, in the way that Adam has described it, that it's worked perfectly since its inception, that there is some art to it, and just as we can't value, or just as we're not sure what a valuable piece of artwork is worth, a Chagall or a Picasso, and we can argue that how could a painting, which is just oil and paint and canvas, how could it be worth 40 million or 50 million or 90 million dollars? But yet it is to some people, to many people. I think likewise there is some art to Bitcoin. There is an art to its network, and there is a narrative to it. And I think we've seen in human endeavors that items have become stores of value because humans assign meaning to them and assign value to them. Anybody have any comments on that?
I would add that, I mean, we've been talking about all the reasons to be bullish Bitcoin so far. Let me share one of the reasons not to be bullish. Is art that gets put on a brokerage statement art? I mean, it seems like it becomes less artful once you assign a value to it in that way and put it on a brokerage statement. And I think that the art that Ben Hunt was describing that Bitcoin is, it's like this whole sort of dream that all these early Bitcoin enthusiasts had of a decentralized finance system, a currency, that couldn't be controlled by any kind of centralized entity. And the idea that you could create a finance system from the ground up that's decentralized, that doesn't have any centralized control. And it's a beautiful idea. It's an artful idea. But these ETFs are sort of the opposite of that idea, which doesn't mean that the Bitcoin price can't go up. But what these ETFs are doing is they're pooling very large dollars of assets into a single entity that is going to buy a bunch of Bitcoins and store it in, with one custodian. In fact, I think all of the Bitcoin ETFs are storing their Bitcoins with the same single custodian, which is Coinbase. And so it's sort of ironic that even as there's been this sort of groundswell interest, this surge of interest in this supposedly decentralized asset, the mechanism that's really causing a lot of mainstream interest in investing in this asset, almost by necessity, is centralizing the asset, the ownership of these assets into the few financial entities that manage these ETFs, and then all of them custodying their Bitcoin with the same entity in Coinbase. And by the way, Coinbase, unlike JP Morgan, is not a too big to fail bank. It's a cryptocurrency exchange, a cryptocurrency exchange that's gotten involved in a lot of fights with the government. And it's a cryptocurrency exchange where there isn't settled bankruptcy law, where if Coinbase were to go under, you necessarily know exactly that the Bitcoins that are custodied are going to be safe and held for the investors. I think it's likely that they will be held for the investors. I'm just saying it's not settled law yet. And so that, I think there's a couple of risks of these Bitcoin ETFs. I think, the sort of counterparty risk you have of your dependence on Coinbase is certainly one of them, and worth thinking about before investing in Coinbase. Investing in these ETFs. It's not a reason not to invest in the ETFs, but among the major risks that exist, to me, that stands out as one of the two big risks.
No, I think that's a fair point. I think that's a very fair point. I think also a major risk to Bitcoin in general, whether you hold it in an ETF or whether you hold it in an exchange, obviously not true if you hold it in cold storage, is that the Bitcoin is only as good as its network, right? That network, it is an internet-based store of value. And if the Bitcoin network, the internet somehow goes down, gets compromised, if cables get cut between us and China in some war, it's possible that, right, your Bitcoin value might disappear or might be compromised. That's something that, again, is probably a low probability event, but it's out there. So yes, there are plenty of risks. A bigger risk pre the ETFs was that the U.S. government might outlaw Bitcoin. That could still happen in the future, of course. That seemed to be taken off the table as Wall Street co-opted it, and as the big financial players got into Bitcoin, as Adam was saying. I think the good side of BlackRock and Fidelity and the major players being allowed to operate Bitcoin ETFs was, it seems that the government has allowed the big financial houses to play in Bitcoin, which should make it safer and less likely to be outlawed. But it's still a possibility. But Adam's point is right. This originally was something that existed outside the financial system, right? It was a way to be counter to the financial system. And now it's been, by these ETFs, it's been co-opted by the financial system in some ways, just like gold was with the gold ETFs and the paper gold market. But certainly there are risks here.
I would argue that the risk of government involvement, though, is much greater with Bitcoin than it is with gold. Every country has a central bank that owns a lot of gold and has been buying a lot of gold. And so gold is an integral part of not just the financial system, in that you can buy gold in an ETF, but in the monetary system, and that every central bank around the world owns gold. With Bitcoin, perhaps with the single exception of El Salvador, I don't think that there's a single central bank that owns any Bitcoin. And so Bitcoin is, make no mistake, it's a big threat to the financial system. If Bitcoin goes to the moon in value and central banks don't own any of it, that's a problem. That's a problem. And I think that if Bitcoin goes to the moon, it means that the opposite of going to the moon is happening with fiat currencies. And in desperate situations, governments do desperate things that usually involve putting in capital controls. And so what seems like a likely government move today, or an unlikely government move today, it could be less unlikely in a more desperate situation. So again, it's not a reason to not own Bitcoin. I think that the more people own Bitcoin, the lower this risk is, because you're not going to want to harm too many people who are able to vote you out if they get angry enough. But it's that to me is the second really big risk of owning these Bitcoin ETFs. It's just that the government has grudgingly approved these ETFs, but it's not really a government approved asset, in my view.
What do you mean when you say that, Adam? It's not a government approved asset. I mean, none of these assets are government approved, right? But I mean, for them to take, the purpose of the SEC is supposedly to protect investors. And if you've got 57 billion or whatever the number is in Bitcoin ETFs, and you're suddenly going to change things, doesn't that make it approved as any other asset would be?
Billy, correct me if I'm wrong. My understanding is that the SEC was forced to approve this. They lost some kind of a lawsuit related to it, I think.
Well, yeah. I mean, it was Grayscale, which was, this is how our clients those who own it were able to participate in Bitcoin. But Grayscale had a closed-end trust that, like a lot of closed-end funds, traded at a discount or premium to net asset value, and they applied for a spot ETF. It was only the federal courts, right, that ruled that the SEC was being arbitrary and capricious. That was a quote from the courts in denying the spot ETF application to Grayscale, and that paved the way for these approvals to happen.
Right. So the SEC didn't say, "Oh, we love Bitcoin. Let's approve a bunch of ETFs." It was more like, "We hate Bitcoin," and the courts said, "You can't really just do that." And that's because there's no laws that have been passed to talk about Bitcoin one way or another. So there's no law against Bitcoin. And therefore, according to the law, there's nothing wrong with it. So the SEC approved it, but they didn't approve it because they approved it. They approved it because they had to approve it.
Agreed.
And Adam, I think your point about the assets that central banks own and don't own is an important one, right? I mean, there are central banks all over the world that own stocks, and they own bonds and all that sort of thing. Those are approved assets, right? Oh. And gold, exactly. The central banks own it. That's an approved asset. And they don't own Bitcoin.
Yeah. I think all these are. I'm going to share my screen again for a second. I think all these points are important, and Bitcoin has risks, right? Adam brought up a lot of very, very good risks. There's a lot of risk with Bitcoin, so that's not to be forgotten about. And I think because of those risks, an allocation to Bitcoin should be smaller than in other less risky assets in the portfolio. I will counter some of those risks with what you do get from Bitcoin, or at least what you have gotten from Bitcoin in terms of return, with the understanding that past returns are not indicative of future returns. But I don't think people, sometimes the numbers are so big it's hard to grasp them. And again, this may not happen going forward, but it has been arguably one of the best returning assets out there. Now, if you could see my screen, this is on a 1 year basis. Now, I wish I could change the colors, but I can't. You'd think the gold would be gold, but this is Bitcoin and gold at up 100 over 1 year. And I'm doing it versus gold because Adam pointed out there are less risks in gold. I think there are less risks in gold. I think one of the most important things is that central banks own gold, so you're on side with the central banks, whereas most central banks don't own Bitcoin, which I think is an important point. But for that risk, that's a 1 year period. Interestingly, they're the same over 3 years, and then 5 years Bitcoin is up 1,000 over 1,100%, which is just stunning. These numbers get, and over 10 years Bitcoin is up 11,000%. I mean, the numbers are just gargantuan. Now, this is admittedly from a very, very small base when Bitcoin came out at under a few cents a Bitcoin originally. So don't expect these types of returns. But I don't know in modern finance if we've had an asset class in a 10-year period of time that has returned in the way that Bitcoin has returned.
I mean, there's no question. There's nothing has done anything close to that, right? But I mean, that was then and this is now. The question is, A, is it safe? B, does it help with a portfolio diversifier in terms of improving the risk return portfolio? I would argue that it does. But as we said earlier, it's got to be a very small number that allows the investor to sleep well at night, knowing that their lives are not impacted negatively, should something terrible happen to this asset class. And I'm not saying that it will. I don't believe that it will. I'm just saying you still, you got to value your sleep as well.
I'm a believer in keeping asset allocation small to Bitcoin, and it's very client dependent. Not everybody's going to want to hold this. And if they do hold it because of the enhanced risk that we talked about, I think the allocation should be small to help mitigate that risk. I'm going to share my screen a little bit again, and just to talk about Bitcoin, the halving that just happened because it's so topical, and past Bitcoin cycles, which may be instructive of where things are going. Bitcoin is an unusual asset because it seems to follow over and over patterns that are based around these halving cycles, which happen every 4 years, where the supply of Bitcoin mined is cut in half. So this is, which is kind of interesting. Here we have, this chart is as of last week, or April 16th, maybe that was this week. I can't keep track anymore. I think it was last week. And here we have from the start of Bitcoin halvings here. So this day zero of the Bitcoin halving. So the Bitcoin halving, I think, happened around April 20th, April 18th or April 20th. And historically, at least, this is the 2013 cycle. This is in black. In purple is the 21 cycle, and in green is the 17 cycle. So these are the three previous halving cycles that we've had. And you see that basically you have the biggest outperformance historically at Bitcoin is in this hype phase, which happens post-halving. And cycle tops tend to happen anywhere from 100 to 400 or 500 days post-halving. So you basically have, if this is instructive, and the halving just happened last week or this past weekend, if history is any guide, the biggest outperformance in Bitcoin has happened basically a year after that initial halving. And then you get into, or a year and a half, and then you get into a disillusionment cycle, which we certainly saw in 21, 22, where Bitcoin tends to go down for a period of time, which is usually another year, a year and a half, but or 2 years even, depends on the cycle. And then we have this accumulation phase that kind of grinds higher into this next halving, which I guess the next halving will happen in 2028. So these are, I think, instructive cycles, but again, it doesn't mean that this cycle will look like the last ones. But here is another chart to elevate where we are today. If against these past cycles, this yellow is, or gold is, the genesis, the very first halving cycle when Bitcoin was incepted. The red is that next cycle. The blue is the cycle after that, and the green is the most recent full cycle. And here we are in black today. So again, we are at the 0 point in halving. And, if history is any guide, the next, 24 to 36 months, as I said, year to year and a half, historically is the sweet spot for Bitcoin returns.
That's sort of charts. Yeah. Pretty bullish.
Well, that's really, that was kind of my point of saying, okay, we have a lot of risks. We understand Bitcoin, and I think the time of this call is opportune because we really are at day zero, right, of halving, or day 7 post halving. And if history is any guide, if anybody is interested in Bitcoin, this is likely the best year to year and a half to be an investor.
If you're going to buy, now would be a good time to do it.
But with all the caveats and all the risks that we've talked about before, which still stand, and with the knowledge that this cycle may look very different than the previous 4 cycles before it.
I feel like you should drop the mic right now.
Well,
You make a good case, Billy.
is there anything else anyone wants to raise about Bitcoin or?
Well, I have a question. Should it just be Bitcoin? Should you be looking at Ether? Should you be looking at other coins? Are the rest of them too unproven, too volatile for the regular investor to be in? And it really should be the world of institutions and dark alleyways, or is it, or for now, really, Bitcoin is the best place for the investor to be in from risk return perspective?
Well, that's a hard question. I'll take a stab at it. These other coins, which in more glowing terms are called altcoins. There's less glowing names for them, but I'll call them altcoins for the purpose of this call. I would say that there's a lot more risk in these altcoins, that they don't have the network effect, the history, the kind of institutional adoption that Bitcoin has. There certainly aren't public ways, or ETF ways, I should say, to invest in them in one's portfolio. You have to go on a crypto exchange, and I'm not here to condone those coins. There is a whole galaxy of coins out there. We don't even have enough time in this call to talk about every one of them. So to your point, Josh, I don't think investors who are interested in crypto should be invested in altcoins unless they're going to spend a lot of time researching those coins. Ethereum, if Bitcoin is considered the kind of the gold standard for crypto, Ethereum is considered the silver standard for crypto. There is a closed-end fund way to own Ethereum. The only 2 cryptos where there are futures traded on the CME are Bitcoin and Ethereum, and there are Ethereum ETF applications pending. The SEC is supposed to respond in May, actually, as to those applications, although they don't have to give a decision. Then it might be kicked until later this year. So there's the possibility that, and there's an argument out there that Ethereum, because it's traded in the same way on the CME exchange and there's price visibility, that should be made into an ETF, and it would be a second crypto asset class to own. I think it's one more degree of risk after Bitcoin, and I, for the sake of this call, would love to keep the focus on Bitcoin and think that crypto assets should be primarily allocated to Bitcoin, with only a small set of people invested in ETH if they really have the crypto bug.
It's a fair point.
I want to bring 2 additional points to the table that I think is worth talking about. One that adds to my bullishness about the Bitcoin price, and the other that is perhaps a reason for caution. We've talked about the fact that an ETF exists today. You can buy Bitcoin in an ETF. To me, that development, which occurred just a couple of months ago, is far more bullish than the fact that there's a halving that's going on right now. The reason it's more bullish is because there's just a ton of investors who would love to own Bitcoin, would love to have an allocation to Bitcoin, are not going to ever want to go through the trouble of going on Coinbase or whatever exchange exists to go buy Bitcoin and figure out how to store your coins. And it's just too much headache. If you can just go on your Schwab account and put in a trade for Bitcoin like you would put in a trade for Apple, well, I'll hit the easy button. And so I think right now, retail investors are moving into Bitcoin in large quantities, but a lot of the big institutional investors have to go through this whole decision process before they can buy Bitcoin. And there's a huge amount of money there. And they're going through that process. And they're going to be approving an allocation of Bitcoin to 1% or 2%, whatever small number it is, but it's a small percentage of very large pools of investment dollars. And so that, in my opinion, is going to drive a tsunami of money into what is a pretty illiquid asset. There's not a lot of Bitcoins out there that are being mined that you can just buy. So the only way all this money coming in is going to be able to buy those Bitcoins is by driving the price high enough to convince people to sell it at a high price. And so just from a sort of short-term trading standpoint, I think that's an enormously bullish development. And I'm just talking about the US market. We were talking before this call started that in Hong Kong, they just approved an ETF. It's not available yet, but that ETF is being launched on April 30th. So if we're seeing Bitcoin ETFs launched not just in the United States, but in major countries around the world, and you've got institutional investors who now feel comfortable enough to put an allocation into Bitcoin, I mean, that's in the short term, very, very bullish.
Yeah, I mean that whole demand story was the story behind the creation of these ETFs. That now you have a way to, as much as there are many negatives about the Wall Street's adoption of ETFs that you talked about, I think, and spoke fluently and well about. The upside to Wall Street's adoption of ETFs is, you see other countries beginning to adopt them, which often happens, right? China, it's under consideration in the UK, and you don't even have many asset managers in this country yet that have approved the investment in those ETFs. There is a potential tsunami wave of demand out there coming for Bitcoin.
Yeah. Now, I mean, the flip side is once that investment comes in, when Bitcoin starts going down in price and everybody starts to sell because the performance is now negative, well, who's going to buy it then? So there, it'll go both ways. But for now, I think it goes up. Could be wrong, but that's sort of my short-term view of things. I guess the reason to be cautious then is I saw some chart the other day. I should have brought it here, but it basically showed a very strong correlation between the price of Bitcoin and the 3 times levered NASDAQ ETF.
Yeah.
And I wouldn't want to own the NASDAQ. I certainly wouldn't want to own the 3 times NASDAQ ETF. I'm hoping that that's like one of those correlations that just is like, wow, what an amazing coincidence. Isn't it interesting? And then at some point they stop correlating or whatever. But if Bitcoin's price is going to track going forward the 3 times NASDAQ ETF, I wouldn't want to own Bitcoin.
You're absolutely right about that. And what's interesting, yes, you're absolutely right about that. I've seen that chart too, and it's kind of scary. And correlations have broken down, right? Bitcoin's been correlated with NASDAQ before, and then it broke down, and NASDAQ was correlated with rates, and then that broke down. We certainly, in that original chart that I showed you, saw a ever decreasing amount of volatility for Bitcoin. So it's hard to argue if that continues and the asset continues to grow. And if that lower volatility continues, it's hard to argue that it would be as volatile as the 3 times levered NASDAQ ETF. But anything is possible, and that is a word of caution. It has traded like that. Yeah. I will share one more chart because your comment about demand reminded me of the early days of the internet, and the internet, as we all know, was hard to believe, but going back 25 years or so, even 30 years, was clunky. You had dial-up, you had slow internet speeds. It was hard, just as it was hard for people pre-ETFs to trade Bitcoin because they had to get on a certain crypto exchange. They had to get maybe a cold storage or a Bitcoin wallet. It's been very difficult until the ETFs came out to basically hold Bitcoin. And so the adoption has been slower. Likewise, 25 years ago, we forget now, but the internet was also more difficult to join just because speeds were slower. And there's someone, this is public. This is a public document issued by Fidelity. I think Jurrien Timmer, who is the macro or crypto strategist at Fidelity, does some really interesting work. So this is something that's out there. And he has a price chart looking at basically real rates, again, correlation, and the size of the network. And he basically says, well, if Bitcoin grows like internet adoption grows over time, this is what the Bitcoin price might look like given also the impact of interest rates. And so I was thinking about that, Adam, as you as you made that correlation. So let's take a look at this chart real quick. Now, of course, this may not happen. And again, this is not Pekin Hardy's price forecast or my forecast. This is a Fidelity, again, a public document that's out there by Fidelity. And so what you have, the way they've done it, and they've said, hey, Bitcoin is 91% correlated to the size of the Bitcoin network. You know, again, we all know that historically internet companies got more valuable, right, as their networks, right? These platform companies got more valuable as their platforms got bigger. And it's also been correlated to the level of real rates. And we've been talking a lot at Pekin Hardy about real rates. And if you believe, as we do, that the only way out of our fiscal situation is to keep real rates negative, then that should be a boon to Bitcoin. And so I think what this is looking at this top line is keeping the Bitcoin model grows like the internet adoption model globally, and real rates are negative 2%, which is quite possible to get there again. That's not where we are today. And the lower line is we have the same internet adoption growth model, but real rates are positive 2.5%, which is closer to where we were in the last year. But you can see this only goes out to a year from now, or I should say a year and a half from now. But at the high and low, and again, right, there's a lot of, you can see the Bitcoin price volatility, but it's largely tracked this, right, for 10 years, these two bands. We see at the high end potentially a Bitcoin price at the end of 2025 of over 100,000, or maybe potentially Bitcoin price at 50,000, or it could be lower. You know, today we're at 65,000. So it's interesting to see how this correlates with, you know, past internet adoption trends and real rates. And if the internet adoption trends can be overlaid to Bitcoin adoption trends, and if real rates stay negative, then you can make an argument that this upward band for the price of Bitcoin is quite achievable in the next 18 months.
It's an interesting chart. It just leaves me wondering why Fidelity doesn't believe in using dollar signs and commas on their y-axes.
You can call them, but yes.
You know, I'm just a little bit skeptical of the internet adoption theory, because again, the internet adoption theory assumes that Bitcoin is a signal of like the financial system becoming really, truly, unambiguously decentralized. And I think Bitcoin, or I mean, you know, I don't know, it doesn't feel, that part to me doesn't feel real in the way that internet adoption felt real. I mean, I'm not feeling how decentralized finance is affecting my life today. Whereas, you know, 5 years, 6 years into the internet, or, you know, at least the first browser, I mean, you're using the internet regularly. It didn't affect everybody, but it affected a lot of people in really meaningful ways. And, you know, other than the fact that, you know, I can buy this asset now whose price seems to just go up at a very rapid rate, I don't see how it's changing people's lives.
I think you've got to start to see people use Bitcoin more as a mechanism of exchange, which, you know, is so far from where we are right now. It may never happen.
It's not. But that's, I mean, you know, Gresham's law is this you know, law of money that basically says when you have two different currencies, one that's a hard currency and one that's a currency that's being diluted quickly, that any rational economic actor is going to hoard the hard currency and spend the easy currency. And that's exactly what we're seeing. You know, like this whole idea of like, you know, you're going to be able to go into a coffee shop and buy a cup of coffee for, you know, however many Bitcoins instead of using dollars. Why would you possibly want to do that?
You wouldn't.
I mean, the monetary base in dollars is continually expanding, whereas we spent the big part of our early conversation talking about how deflationary Bitcoin is. You're not going to want to spend Bitcoin. You're going to want to hold and hoard Bitcoin and spend your dollars. So I think if anything, the price of Bitcoin going up the way it has is causing people to want to spend Bitcoin less. In fact, I think within the Bitcoin community, there's a huge schism. They forked this other coin called Bitcoin Cash that was supposed to be used more as a medium of cash because they saw that people weren't really using it as Bitcoin was originally intended, I think, as a medium of exchange. But people just started buying it because the price was going up and hoarding. And when that happens, I mean, there's just no way it's going to become a medium of exchange. It would be irrational to do that.
Yeah, I think Josh, a typical criticism is that, right, it needs to be a medium of exchange, and I think to Adam's point, it's not going to be one, because why would you ever use this, this thing that has gone up 11,000% in 10 years? It's not something that lends itself to exchange. There's no reason to use this as a medium of exchange. And you're right. I mean, again, this is a forecast, right? This is a forecast. This is Fidelity's forecast. It's not our forecast, and it may not happen. It will, and you're right. I mean, it's hard to believe that the Bitcoin network will get as universal in our lives as the internet network has for most people. And I think that's a good point. That being said, we are certainly in a world, as we know, of monetary debasement, right? That is accelerating rapidly. And we are also in a world where Bitcoin truly is a global asset. You just need an internet connection. And we have, I think, a very Western mindset. There are billions of people out there living in countries who may not trust their financial system. So there is a lot of room for network growth in a lot of this country. And I think what's interesting, again, is how tightly the Bitcoin price has molded itself to this band that's been created. Again, that doesn't mean that it'll continue that way. And Adam's point is right. It may not, and the Bitcoin network might stall for a number of reasons that we've already talked about. But it's interesting to think about, certainly as a frame of correlation and reference of what might happen. But this is also clear. There's downside, right? We're at 65,000 today, and it's possible that Bitcoin will be negative from here, right? I'm not saying it's just an up case. There is a down case, right? You could, depending on how the network grows or where real interest rates are at per this model, you can see Bitcoin at 45,000 or 50,000 in a year and a half, in which case would be a very poor investment for the next 12 to 18 months.
Right, but the trend, I mean, if this network adoption model is correct, the trend is the trend is generally up, even if you happen to buy it in the short run at the wrong price. Although your charts showing what happens after the Bitcoin halving would suggest that the timing is probably pretty good to be owning it.
Yes, and I think importantly, as we know, as the fiscal situation gets worse for most Western governments, very positive real rates are very, very hard for them to maintain. So likely we will be a negative real rate environment, which augurs for the top side of this band as we approach the May or June decision of the Fed to likely decrease interest rates. But we'll see. I think maybe we've talked a lot about this, we've carried on for a while. Maybe our audience has had enough. Any last comments?
I think I would say, entry point for Bitcoin is less important than allocations. And I just, you just need to do an allocation that allows you to benefit from the diversifying nature of Bitcoin and allows you to sleep well at night, and you're not risking your financial future, right? There was a wise man I know all too well who said, if you're rich and you want to stay rich, you diversify. If you're poor, you want to stay poor, you diversify.
This is not an endorsement for a majority of one's assets in Bitcoin at all.
For sure.
Again,
we've made that very clear.
Yes,
yeah.
It should be, I think, ideally 1 to 2% of one's portfolio. I think that's what the allocation should be.
This is a great discussion. Thanks, Billy.
Thank you all. Thank you all
right.
for joining.